Happy Tuesday, everybody. My name is Andy Ellett. I'm a realtor here in Williamson County, Tennessee. I'm with my best bud, Rodney Wilds, who is a loan officer also in Williamson County, but I have it on good authority. He services the U.S. So if you've got lender stuff, he can take care of you. What do you know, man?
It's a great time in Tennessee. You know, we've got football going on. We've got great weather for a couple weeks in a row. My son's still alive at his first few weeks in college. That's always a great thing.
Is he freshman? First few weeks. I mean, it's
He's a
freshman, huh?
freshman. Yeah, it's my second one. I've had one graduate from UT, and he just one graduated and one started right back to back semesters. So.
Ow. Well, I'm here's saying prayers for your business. Hope it's going good.
You know,
Like I said,
it's not crazy expensive. Uh, in school or states that in school states or whatever, it's not crazy expensive. It's really affordable in my opinion.
did you see? I don't know if you would have happened to have catch this the other day, but I watch a lot of the business news and stuff, and Ramsey was on there. It was on Fox Business or something, and they don't necessarily, for anybody that hears Fox and gets immediately turned off, the business channel doesn't necessarily go the direction that other programs go. So I mean, I just think it's solid, good business advice. But he was talking about colleges. This is Dave Ramsey, I'm sure he's a billionaire by now, and he said, why would you send your kid to go to a $270,000 a year school to get the same education that you get at a state school, And he was, he was very strong about that.
Where did he say where he went?
I think that if you ask him, he goes to the School of Hard Knocks, didn't he? I mean, I think he's been bankrupt a few times, and he's got a hell of a story,
Yeah.
And
Yeah, I mean, it's all relative. If you're Elon Musk or something and you're earning probably $6 million a day in interest, and you want your kids to go to a private school or a school, maybe a very expensive school that you went to or whatever, it costs that much. It's all relative.
yeah.
But in a regular layman like me, no, I'm not. I can't afford, a regular person. I can't afford, Harvard or wherever else those places that cost like that.
Yeah, well, and for Andrew, we're talking about Dave Ramsey, who happens he's local to us. I mean, Rodney could drive to his house like in about 8 minutes. You're just right, he's right there, And
I could drive to the start of his house.
this, yeah, take you a few minutes to get down to the other end. But I bet you that he practices what he preaches, even though he's well deserved. He's wealthy and well deserved. He really is. He teaches a lot of people and helps a lot of people. Not everybody agrees with his politics. I don't. But he helps an awful lot of people. But I bet you, if he were to have another kid, they wouldn't be going to the Harvard stuff. I just bet. Maybe I could be wrong, but anyway. So here we are on the precipice. I am ready. I did a video on this yesterday. What we're talking about is mortgage rates seeing a huge drop, and it's relatively speaking, it was, I don't know, 20 or 30 basis points, right? From 2.5 or 6.59 to 2.629, something like that. Basis points, 0.1%. And then we're looking at Jay Powell and all the gang getting together to talk about Fed funds rate here in a couple of weeks, week and a half, something like that. And I mean, in terms of, this is the way I see this, is what a perfect laboratory for proving to people, if we pay attention, that how closely do mortgage rates follow the Fed? I mean, because everybody argues, if the Fed would just cut rates, I could afford a house. I mean, we've been hearing that forever, you know. And that's so now I'm going to be watching this really close, you know. So next week or whenever they do that, we're going to be talking about that because if they I mean some people are making some of those governors, you know, I guess there's 12 of them governors. They're talking about a 0.5%, or even one guy said 3/4, but maybe not. I mean, could you imagine coming from nowhere to 0.5% anyway? I mean,
No,
we're
I
talking.
can't imagine it because he's not going to do it. He has been stingy. He's proved to be stingy. I don't think, yeah. But that's what's so good about it. The conversation that a half is even in play now. So it's almost a quarter. Was already to me already going to be happen, but now they're talking about a half. He has to do a quarter. I mean, it's
Oh,
pushed the ball there, if that makes sense.
oh, it absolutely does. And then there's one other thing I wanted to chat about before we get out of here for the day is the jobs report. And I got to remember what my point is on that, but it's kind of cool when you see the revisions that came down today, like 2 hours ago.
Hmm.
He's basing, I guess I'll spoil it now. We can go back to it. But the thought is if this guy, Jay Powell, is if he's modifying the Fed funds rate based on jobs, because that's one of the two mandates, right? In inflation and the jobs. And if he's moderating things based on the jobs report, and it's off by $900,000, or I mean 900,000 jobs, well, what doesn't that kind of mess with your metrics? I mean, you're cutting and holding on for numbers that are bad. I don't know. For a data guy, could be a problem. But I digress in a big way. I was just really sweating over trying to. I just thought that was an interesting point. What do you think about that? If he's
Yeah, I
making,
think it. Yeah, I think it's been a foregone conclusion that he's going to do a quarter.
yeah,
Um, and now there's talks of a half. I think that definitely solidifies us getting a quarter. And potentially a half. If he puts a lot into this jobs report, which I don't think he will, but if he did, that would be significant.
that would be significant. So let's dive into this first one, and it is there. We go, perfect. I really like this format we're doing these days. The mortgage rates see the biggest one-day drop in over a year, and you can see where I know you can't read this, Ange, but it's kind of a visual and keeps me on track. So I apologize about that. The average rate on the 30-year fixed mortgage dropped 16 basis points to 6.29 on Friday, according to Mortgage News Daily. That's the one I watch. And I know that it always trends high based on what Rodney could actually give somebody based on their credit. Following the release of a weaker than expected August employment report, it marks the lowest rate since October 3rd and the biggest one-day drop since August of 2024. Rates are finally breaking out of the high 6% range where they've been stuck for months. This was pretty straightforward reaction to a hotly anticipated jobs report, said Mortgage News Daily Matt Graham. It's a good reminder that the market gets to decide what matters in terms of economic data, and the bond market has a clear voting record that suggests the jobs report is always the biggest potential source of volatility for rates. And I mean, mortgage rates tend to follow that 10-day treasury because that's where the big boys park all their money. Maybe they do, maybe they don't. Depends on which of those two is the best deal: MBS, mortgage-backed securities, and 10-year treasuries. The drop is a major change from May, when the rate on the 30-year fixed peaked at 7.08. Remember your prediction a while ago? This isn't to cast aspersion. Was 8%? Remember that? Oh man, and we got dangerously close to that stuff. It's big for buyers out shopping for a home today, especially given the home high prices. So the high home prices. So I thought this was pretty neat, and maybe you can expound on this a little bit. Take, for example, someone purchasing a $450,000 home. The reason they use that number is that's kind of the median home price across the country. It's higher in California. It's certainly higher in Williamson County. Franklin, it's $1,800,000, so, but the average across the country is 450. Example, somebody purchasing a $450,000 home was just above August national median price using 30-year fixed mortgage with a 20% down payment, not including taxes and insurance. The monthly payment at 7% would be $23.95. At 629, that payment would be just $22.26, a difference of $169 a month. In your opinion, because you're the behind the scenes guy, you get to see what's really going on. How many dollars per month does a buyer have to save where it's truly significant in your view and all the loans that you've given?
Well, I'm cheap. So, you don't have to save much for me to say that. Like when a $450,000 saving $169 a month, that's significant, very significant to me. Obviously, and that's just from a rate decrease. So
Right.
that the numbers, and a lot of it just depends, what your initial sales price is and how much residual income you have after all your bills are paid. $169 at that price may cover somebody's phone bill too, so it's a phone bill and trash bill or something. So that's pretty nice.
It is pretty nice. And Ange asked the really important question, and because I've got listings now that are there's some waiting going on with buyers, and her question is: so with several rate decreases expected over the next few months, do you think buyers will wait for a while? In my opinion, the answer is probably yes. That what it. What do you think, Rodney? Before I go on,
I think they're already waiting. Like, to say yes is just kind of an easy answer because everybody's still going to be waiting, even if the rates drop a little bit. Like we may be in some of the slowest times we've seen.
30 years.
Yeah. So they're already waiting. Wait, if the rates drop some more, yeah. And correct me if I'm wrong, Eddie, but it always seems like procrastination and buyers on the fence is a common term in our industry. I think people wait and they procrastinate just for the thing. It's such a huge decision, I think. And if people are slow to make decisions and don't buy houses fast, absolutely, they're going to procrastinate. They're going to try to time the market. There's a lot of reasons that get people to wait. And I'm not so sure that waiting isn't a great option right now. I'm just saying that typically people find ways to wait even when it's not the best time to wait.
Absolutely. Oh man, I'm telling you, that true statement never said, because the difference between a reason and an excuse is you're always going to find another excuse no matter what. If it's no, it's cloudy today, so we're not buying a house. Got it. Reasons is a different category. That's which brings us to the point, and Rodney has been big on this. And so Ange added in this, and this is such a good discussion. It really is. So maybe March. I'm going to say not that. That's all of a sudden in the middle of the spring and everything. The buyers, regardless of what's going on, they're going to be coming out because it's spring, and prices are going to probably tip up a little bit. The question I think that's important right now is, does this rate cut look serious? Does it seem stable? I mean, I think the economy is showing signs of it really is stable. This is a solid economy. I don't care it just is. The jobs report notwithstanding, and we were just talking about, seems to get revised. They said the next revision on the bigger picture is in January for the job. So, God, what numbers do you watch until then? So, are people going to be waiting? Some will always wait no matter what, but then there's going to be trigger points. Because I guarantee you, I guarantee, there's some people that have been waiting for 6.5. Once it hits 6.5, we're going to start looking again. We're going to get serious. And there's going to be people that say, once it's 6.4, we're going to start looking, you know? I mean, that drop from 6.5 to 6.29, call it 6.3. And we just gave you the numbers, you know, they were going from 7 to 6.29, from 6.59 to 6.29. The difference is probably $70 maybe. Is that a reasonable guess?
That's roughly half of what it was. Yes.
Yeah, maybe $70. And that makes a difference. People are going to trigger on each one of those points. So there's not going to be a flood. And that's why I think that the market tends to moderate itself. It balances because a bunch of people come out and others are waiting, you know, that kind of stuff. So I think March is way too far off. I think that when the rates drop because he's going to send signals, he's going to say whatever he says, you know, in code, that means, you know, next time we talk, we'll probably do it again. That kind of stuff. I think that this is going to knock a hell of a lot of people off the fence. Not the Fed funds rate per se, except that as a direction, but the 6.29. I'm telling you, people are calling their lenders today because it's better than it was. That's my opinion. So March is a little bit far off, in my humble opinion.
I'll throw something in there just
Got it.
because we talk about it so much. Is that, Ange, I'd be hyper focused on the area, because when we're talking about this today and how slow it is, and then there's a couple pockets in Nashville that I've seen are still hot with investors, and I'm like, how is investors still buying in that market? Like, so it really depends. It still is local. Like,
Yeah.
you know, if you're looking at a certain pocket, or you're selling where you're selling. So look at local. Like what we're talking about just doesn't apply everywhere. You know, like it's 90% of the country. But when I'm reading articles about our local real estate that are bucking some of these trends, it just always goes back to like, man, real estate is so local. So that's just, you know, my 2 cents.
Uh, and the other thing is too, when interest rates go down, I mean, like to that 6.29, to the untrained eye, that may seem like a huge number, but when it really boils down to like $70, that isn't necessarily a ton, you know, but it's worth it. What's interesting is as the interest rate goes down, I think a lot of people end up just buying more house. you know, they're just, you know, if I can get a $470,000 house instead of 450, that's what they tend to go for because they've already got that monthly. I believe that most everybody except Dave Ramsey probably buys with the target amount on a monthly payment. I'm betting that probably happens. And if you
Sure.
can get,
It has to fit in their monthly budget equation. I mean, it's everything's broken down into monthly. So yes.
yeah. And instead of saving 169, they'll look at a slightly bigger house. And so what I'm trying to say is when you're looking at houses, when you start the process, it's a learning. It's like let's say your price range was 400 or it's 350. Let's say it's 350, 450. Who cares? I don't care what it is. And you're looking at houses and you're maybe not terribly excited about it. Well, you push to 400, those are nicer houses. It's a whole different category of difference where you get an extra bedroom, extra square footage. It's just interesting how people will fit more house into that budget if they can. And that's what the lower rates get you, is a bigger house. So when people are ready to buy, this is what I will tell you. When somebody calls and said, I'm ready to start looking at a house, 3 to 6 months is fine. I can almost guarantee you within 4 to 6 weeks, you got a contract on something. Because once somebody gets excited about it, it's like, there's blood in the water now. You're out looking at
Yes.
houses getting fired up.
6 months. If a buyer tells me they're looking and they're planning on 6 months, that means
6 weeks.
very, very soon.
It's like yesterday.
Yeah.
It's
I
funny.
mean, it's just, the ball's rolling. They find something they like. They may have thought in their head it's going to take 3 months to find something and 3 months to close or whatever it was, and all of a sudden they're like, find something they like and rolling.
Yeah. And the thing that I always find that gets people past, um, once I get people past the lending part of it, once I've had them have a conversation with Jordan, and he's so disarming. I mean, he's really good on the phone, and once he talks to people and they get comfortable with the lending process, it's not nearly as complex or scary than they thought. And the one thing I would interject is when it comes to like credit, even people who are very careful with their money and pay their bills on time and all that kind of stuff usually think the worst of their credit rather than it's really good. I mean, their first instinct is, I'm afraid to look at my credit because I'm sure that it's bad if they're not using NerdWallet or something like that. But once somebody gets in there and Jordan goes, "No, you're good," it's like, oh, damn the torpedoes! We're rocking now. So I find that really loosens people up once they find that the lending part of it's not nearly as bad as what they thought. But the next thought, here we go. The big question is whether we were just talking about this. The big question is whether the drop in rates will be enough to get home buyers back in the market. Mortgage demand for home buyers, an early indicator, has yet to respond, gradually approving rates. Applications for a mortgage to purchase a home the last week were 6.6% lower from 4 weeks before, according to the Mortgage Bankers Association. Homebuyers grapple with a lack of affordability, sellers contend with more competition, and builders deal with lower buyer demand. Builders are going crazy. And said Danielle Hale, she's with Realtor.com, in a statement Friday after the release of the August employment report. She said, the conditions haven't spelled catastrophe, and I thought this was I actually titled I'm going to title one of my videos. It's called, "These conditions haven't spelled catastrophe," meaning how the housing market was this summer, but it has created a cruel summer for the housing market. I thought that was just, I'm not a negative person. I'm really not. But that really encapsulated what they were saying, what the market has been. Some analysts have agreed that buyers need to see mortgage rates in the 5% range before it really makes a difference. That may be true, and that may be a target for some people. But there's going to be people all along the way that trips their trigger. Home prices remain stubbornly high, and while the gains have definitely cooled, they are not yet coming down on a national level. In addition, uncertainty about the state of the economy and the job market has left many would-be buyers on the sideline. So I thought that was kind of interesting. Do you have any thoughts about that, Ronnie?
Yeah, it's I've been screaming all along that we have, the mortgage rates are just too high. And I think the big factor is somewhere around 5.75. I think that's the last time we've seen a decent study on, what would it take for you to move? We know you want to move. What would it take? And people say 5.75. So we're getting very, very close to that right now. But the problem is that when most of this data was taken, everybody was really, really confident with their jobs. Now, if you start losing hundreds of thousands of jobs, and from what I read, it looked like the jobs report was worse because there's more people looking for jobs, not necessarily people being laid off. So that's kind of two different things there. So the jobs report scares me in a little bit because if jobs ain't solid, nobody's buying. Like if you want to kill a real estate market, kill your job market. and you will not have a real estate market, because you've said this a million times, is like you really feel like the market needs to be stable and kind of predictable, and it's always been where you have to be comfortable with your job before you go out and make this kind of purchase. So the job reports, although it's going to help mortgage rates, it could end up hurting us with, the people applying, because jobs have to be solid and stable for purchasers. I mean, that's just,
That's absolutely true. And Ange brings this up. She says, and it's not because of the rates, also the sluggish job market right now. That is true. Now, what I have discovered, and this is, I've been doing this a minute, and there's some things that are pretty consistent, and that is, at least since the crash back in the day. I mean, I'll say since 2014 at least. Everybody that I've worked with, and there's been a bunch over the years, in the past 10 years, since the crash, and since that Dobbs-Frank Act, that thing that fixed lending and all that kind of stuff, everybody that's looking for a house seems to know what the game is. And those people tend to have, I've never asked anybody, do you feel like your job is solid, because they're looking at a house because they already feel secure in where they're working. That's my belief, Now, there's some people that will start looking for a house and there's a job change unexpectedly, and then you got to get the lender involved to make sure it's the same trade craft or whatever, how that works. I've never quite figured that out. But generally speaking, if somebody's uncertain about their job situation, I don't think we're seeing those guys putting in applications, generally speaking. That's just my take on that. I could be wrong.
Well, you see those, you see the ones that, like, hey, I'm concerned and I'm not going to buy right now. And then
Yeah.
you also see the ones that don't see it coming. How many, I don't know if we've ever had any transactions, but, my company's had a lot of transactions where somebody's lost their job in the middle of it. And that's the other part you see, is when the job market isn't great, is like you'll be involved with them when they're actually lose their job. So so you got twofold there. One, they're sitting on the fence because, like, oh, I'm worried about I'll lose my job in 6 months, and the other ones just don't know they're losing their job, and they could.
Yeah, and that tends to happen. At least, like, there's an area. I'm not picking on it. I'm just saying there's an area east of here. It's Murfreesboro, Laverne, Smyrna, that kind of stuff. And there's like Amazon out there. There's just a bunch of industrial stuff going on. There's people, thousands and thousands of jobs. And that's where you'll have, from time to time, I don't want to call it a mass layoff, but it's a mass of a few hundred people. And I've had that. I mean, it's been a number of years before, when we were headed towards closing and somebody got laid off, not fired, but laid off, that kind of thing. But that's where I tend to see that kind of stuff. And maybe that's just a numbers game in my head. I don't know. But, and I want to make sure to have Ange here. And she said, my son's been looking for a job for over 4 months, sent out hundreds of apps. I wonder, that's interesting. Local, I would assume, I guess. Got it. Okay. Well, I'm sorry that he has to go through that. I don't think that's uncommon these days, which brings me to this next point. While mortgage, and this I'm kind of drizzling on a little bit with the mortgage rate plunge, treating this like one conversation before we get to the Riff. Because this had a point that, and I think Rodney just made it, but I never knew how this worked. While mortgage rates similarly plunged a year ago, the situation today is different. Back then, like now, the unemployment rate was ticking higher, triggered by the SAM rule, and that's like a rolling 30-day thing. I could look it up specifically, but basically the SAM rule, and raising fears of recession. Well, I don't think that's going to happen. Expectations for the Fed rate jumped, sending mortgage rates down. The Fed did lower rates, but surprised Wall Street by starting with the jumbo-sized half-point cut. Then the jobs data suddenly improved, raising fears that the Fed cut might overheat the economy. Bond yields and mortgage rates went back up. That's lost my point. I didn't lose it. What is what Rodney was saying, that when they were talking about unemployment, that none of it wasn't because people were losing their jobs, but all of a sudden more people were looking for work. I mean, and that's a whole different dynamic. You know, I mean, if somebody's sitting on the sideline, then 100,000 or not, because they're all of a sudden looking for a job and it changes dynamics, that's a big deal. I mean, that's a tough thing to monitor. That's what I'm getting at about this whole jobs report thing. And I saw a guy this morning on the business news that said they've got to reformat how they track these job reports. Don't you think the BLS, what is that, Bureau of Labor Statistics?
You know, I don't care how they track it. You know, I do know that through my lifetime, it's been a decent indicator. Like, you know, your jobs just have to be, you know, for my business, which is purchasing homes, you know, jobs have to be stable and people have to have confidence, because they're making such a long time commitment on a 30 or 15-year mortgage. So, you know, they just don't like jumping off the fence with when they don't feel like they're going to get a paycheck in the next couple of weeks.
Yeah, I get it. It's anyway. So the jobs report is a problem. They're going to just have to deal with it. It's mostly going to be. Do you see, before we move on, do you see, with this discussion of a half a point drop, do you see lenders and mortgage bankers, those guys, building in a further rate drop? What do you see happening beyond the 6.29?
Yeah, possibly so. I see some people that's if they're talking about a half a point cut, somebody's going to say, okay, well, I'm going to be the first to beat him there, and probably drop our mortgage rates, you know, before, you know, right now, or in the, you know, not now, we're not having a great day today, but you know, over the next before they do that, yes, that some investor could come in and say, I'm going to buy in a little bit more than everybody else, but try to time that. But, you know, if they don't get it, theirs are going to go right back up. Right.
Yeah. Just, I see bigger days to come, and talk about getting people off the fence. And that's, you show me anything that touches a 6, geez Louise. Rodney's phone is going to be ringing off the hook.
Yeah, I think, it's definitely going to help. I mean, rates are huge. And once it hits that 6% barrier, I think in the 5.75, it's going to start peeling some people off the fence.
Plus, you know, I'd love to, this gets me fired up talking about this, because the bigger picture is, there was a time not so long ago when the conversation was Crash Boy was all over the place, right? You know, he's talking about how the housing market is never going to survive this, and, you know, what's going to happen. This injects a ton of hope that things could get better. You show me 629, and I'll show you people that are starting to believe that, hey, you know, maybe we can do this. You know, 629 might not be my number, but 6.2 is, or 6.1, whatever. People are going to be injected with hope, and that is when you're going to start seeing things tick up. And we have to depend on, as far as I'm concerned, those trigger points that Rodney talks about, that everybody has trigger points, and it's layer upon layer that people, it's not a flood, not going to be, unless it dropped to 5 flat up, it would be a flood. But you drizzle it down and people come into the market kind of slow. Anyway, I'll stop. But there's so much hope. Anyway, I'm so excited about that. Do we, any final thoughts before you know what I'm going to do?
No, that's good.
Here we go. Rodney's Riff.
All right. Rodney's Riff here. We got a question from Reddit. Should we lock our rate now or wait? All right. We just got our loan approved 2 weeks ago for a 30-year conventional rate around 6.5%. Our settlement day is not until October 15th. Saw rates drop to 6.3 today, lowest in almost a year. Should we hold out on locking until after the Fed Reserve meeting on 9/17 or lock in now with the option to float down? Okay. They made it pretty clear with the option to float down. There is a lock now with the option to float down. To me, that's zero risk. Like, why are you waiting? Like, like they're giving you the best of both worlds, and and what happens is that we do that as well, and that's the first thing I think every single person missed. And what that is like, I'll explain it like this. If you come to us and we lock your loan in and say we hedge $500,000 on the market and we've got you locked in and rates plummet. Okay. We've already hedged that money, meaning that we've already kind of banked it. But now what we do is we say, well, we understand that the rates have dropped and we don't want this person to leave us and just go down the street and get a better rate because they locked in with us early. So what they have is what's called a rate renegotiation. And if it gets a certain amount better, they get the improvement. It doesn't move very easily. Like, it doesn't move over a couple $100, but if it moves significant up to one point, then what happens is the investors comes back and says, well, we'll give you the difference, and keep the customer, because we know they can just walk down the street and get that new rate. So a lot of people have float down options that take care of that. But there's always the question of, do you lock today or do you wait? And that's the question is as old as a Bible. The thing I'll say about that is, I'm a conservative person, and knowing the system, knowing how fast rates go up, like if they just feel like something's going to happen in the market, the rates can go up. But if rates were to move lower, they're going to move lower a lot slower. But they can move 0.25% or 0.5% overnight. Like, they can, if something happened crazy in this world, they could just say rates just shot up. If you didn't have that locked in, you would be stuck. So one, I always protect against a massive jump. And then I always look at, when I think about people locking in, I look at rates on a chart for, say, 20 years. If you look at that graph, look how small of a time you really have when making this decision when you're buying. Like, you only have a month of, a whole year graph or your lifetime span. You only have a month to make this decision on, should I wait, or should I lock in now, or should I wait? And locking in is pretty much conservative view, in my opinion, just because I use the float down feature, where you're not going to get burned on, you're going to get the lower rate if it goes down. So there's really no downside to locking, as long as you have a float down option. So that's kind of my theory on the rates, is like, you don't have enough time to make any real difference in your payment. Like, you could go down an eighth or go up an eighth, but you're really not going to, but if things were to get bad during that time, an earthquake hit or something, just anything crazy happen, go to war, your rates could shoot up 0.5% overnight, and there wouldn't be anything you could do about it. So my thing is to lock. Don't worry about it. float it down, because it's not going to make much difference between the short amount of time you have to choose to lock or float. So that's what I would say. I'd say lock in and hope you get to use your float down option if rates get better. But at least you're maxed out. So let's jump into the comments and see what they have to say. The very first comment from Available Log 7747. Wait until they go lower, and when they do, wait for them to go lower again. And if that happens, you should wait for them to go even lower. Okay. Jack 5087 responds with, I think I'll wait until they're lower than even lower. So that's what you get to. Like you have to realize, like, if that person was serious and that's what they would do, that's the type of person that's never won at a casino, right? They never can get away. If they win for 5 hours straight at blackjack, they're going to sit there and wait till they lose before they get up from the table. So I wouldn't recommend that. But in cats, plants, I anxious to see what they have to say with cats in their name here. I'm in the same boat, set to close 926. My lender highly recommended we wait to lock in the rate as they are forecasted to drop. Man, I don't highly recommend anybody to lock or to float. I give them information and they decide. And what is forecasted to drop? I mean, the Fed funds, we feel like that's going to drop, but we've talked to that to nauseum that, that is not directly tied to it, although they run in the same parallels all the time. But so they finish up saying, we decided we're going to let it ride and see what happens. Good luck to both of us. Ha ha. I don't think they're making a crazy move right now by not locking, but I just don't get the risk reward for me. Like I said, you get a float down option. You cannot tell me that, you know what I'm saying? You get a float down option. Anyone who says they know, we're going by Evan Jen. Anyone who says they know is lying. No one knows. Mortgage rates are not tied to the Fed. If you have to decide in the next 10 days, I'd lock now. If you can wait 20 plus days, I'd wait. So I like his decision on 10 days, but as soon as he adds 10 days to it, he says he wants to float. I don't get that. But he think, everybody right now just feels like in the future rates are going to be better. Mm-hmm. And that's why I think is driving most of this right here. Jack 5087 response says, I'll have checked with my mortgage broker. I can't recall when we have to lock in by. You have to, well, definitely before closing, but probably a few days. There may be some paperwork responsible for, because once if you disclose the loan as unlocked or the person's floating, you'll have to eventually disclose the loan as locked, and then you have to have a certain amount of days for it to be locked before you can close. So it's just a few days, I'm sure. Electrical bad 3457. Personally, I'd lock in. From my experience, rates tend to adjust prior to meetings in anticipation of a bullish meeting, which could be the case here. Again, just my opinion, lender, but also Reddit user. So, yeah, they understand that the rates are usually built in before the Fed drop. So, yeah, never wait on a Fed drop to adjust your mortgage. Let's see here. Again, we'll skip down. King Ayo says, well, you should look at the 10-year yield and ask yourself what other economic news could make things worse. Friday, we had poor jobs report and prior month revisions were low already. In my opinion, a few things that could drop rates further are a contracting economy via jobs report next month, new war that impacts U.S. directly, or some other sort of black swan. I think it's better to lock sooner if you're able to make the payment work and it fits in your budget. Um, he kind of makes a case to float and then says lock. But somebody says go with Home Depot. The prices are just low. They're lower than Lowe's. uh, and the last one I'll go by is the one here. It's like trying to time the market, lock in. If rates keep dropping significantly, then you shall be able to refinance next year. If not, also good. Won't risk having a worse rate in the immediate term. So that's you get a lot of comments and things on that, and they're all can have their valid opinions, but I just knowing how the float down works, the lock in, how you time it, um, and Angie, I said, is there a limit to the float down option? Yes, you can float down one time. One
Oh,
time.
okay.
And so, yeah, I mean, because it's not like you've only got, usually it's 30 to 40, most closings happen in less than 30 days right now. So, but that person had till sometime in October. So he's got all of September and all of October. So you're not going to see that kind of usually enough to where you'd be able to float down two times in a lock period. In all the years, I've never seen it where you float down twice in a 30, 40 day period.
Got it. Okay. Rodney's
Boom.
Riff.
That's the reality check right there.
That's really excellent. That I continue to, all these years, people will start talking about lending. I'm like, that's a Rodney question. And that's, I'm telling you, that's the verbiage I use. And that's what they'll start to ask me a question. They'll go, wait, that's a Rodney question.
Well, mine's the same when they say, what do you think they'll take for this house? Or, what should we, what should we offer? Or, all those questions. Like, I have no clue. I'm a numbers guy. I know the pictures online look good. I really like your yard or whatever, that's I'm a regular buyer when it comes to that. You know what I'm saying? I can't see the houses and things like that. And like realtors, I'm not abstract or something, I have no musical talents. I can't play any instruments, I can barely walk and play golf. So.
That I don't believe. I've heard rumors that you're pretty freaking good at that. Thank you for the Rodney's Riff. That's always, it gets better every week. You're a beast at that. And that's a really perfect time. Again, I always say this, and I'm going to continue. The reason I like Reddit so much is rarely is anybody ever rude or crass. They're just sharing their opinions, and they are like one side or the other, Wait for it to go down forever. Don't lock yet. Another guy's going, well, I love that,
Yeah.
That's
everybody's in a different position, but so it's good to share.
Yeah, and for the OP, that's what they call the original poster. It leaves them in a position of actually making up their own mind anyway. You've got the full spread, so pick one. The next thing I wanted to talk about, and this I hesitated a little bit because it sort of pokes at lenders a little bit, but not Rodney's company. What happened was there was a victory for home buyers, and the president signs a NAR-supported privacy bill. All this boils down to is when Trump signed into law the Homebuyer Privacy Act, bipartisan, say that again, bipartisan legislation that prevents home buyers from being inundated with unsolicited calls, texts, and emails from competing lenders offering loans. Representative blah, blah, blah introduces the bill that seeks to restrict the widespread and often abusive practices of selling mortgage credit trigger leads. Have you ever heard of trigger leads before, Rodney?
This is you should. I'll let you get into the article, and then we'll Yes, I'll tell you about the stories that we had to do to try to minimize the trigger leads that
Excellent.
as a lender.
Trigger leads are generated when a consumer applies for a mortgage, prompting a lender to make a credit inquiry. Really? 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 So that can cost you credit? That's interesting. I didn't know that. The National Association of Realtors strongly supported this legislation from day one, fighting to end the practice that bombards homebuyers with unwanted calls, texts, and emails at one of the most important moments of their lives. This is a win for transparency, consumer control, and privacy in the mortgage process. We are grateful to the president for signing. Sounds political. Sorry. Act into law. To Representatives Rose and Torres for leading this effort, and to the bipartisan coalition in Congress. I drifted into this thing. I'm sorry. Home buyers now have a stronger shield to protect their personal information, and that's a victory for every future homeowner in America. NAR previously signed this letter supporting that. So, talk to me about that.
All right. So what happens on these trigger leads, or they're called trigger leads? I not sure why the definition is that, but basically when somebody comes to any bank, us, anywhere, we're there at some time we're going to pull credit, and once we pull credit, we only have two, Fannie and I mean not Fannie and Freddie, but FICO, TransUnion, and Equifax, right?
Right.
They're the three bureaus. And so what you do is you'd submit the buyer's information to them, and it'd come back, with your credit report. So as soon as not Fannie, but as soon as these credit bureaus got that information, they would sell it to other banks and whoever with these trigger leads, and be like, "Hey, this person just applied." Selling leads
Yeah.
just like they did.
Yeah. Yeah.
So, but it was Equifax, TransUnion, and those guys that were doing it. It was like they
Hmm.
had a monopoly on the market. And so anytime that we used them as our service, they had a monopoly on it, so we couldn't use anybody else. They would take our customers and sell them to everybody under the sun. And I'm telling you, people would get 60, 70, 100 phone calls within a day. I mean,
Oh,
they're probably going to get 50 or 60 within an hour. Um,
God.
and so, yeah, I mean, and then they're competing against us. And basically what I tell them, say, listen, here's what's going to happen. Like, I tell them up front, like, you're going to get 100 spam calls, about mortgages just because you just applied. So it just felt dirty. I hated it. So what we would do is when we'd take a loan application, we would do all kinds of stuff. We'd put the loan amount at $500 or $1,000, so people would be like, I don't want to buy a lead at that. And then we'd always try to take their emails out. We'd always try to take their phone numbers and the address out just to pull credit. And then we'd have to re-input the stuff back in there. It got so bad, we had just gotten soft pulls approved, meaning we could go in and run an approval on a soft pull, and that means the three bureaus didn't have the information and they couldn't bombard them right then, but they would get it closer to their closing date because eventually we'd have to pull credit. And then it would start, but it'd be so late in the process, at least it wouldn't be as bad as it is now. So we were excited that was passed. It was an awful experience for the customer, but it was just a bad deal where they cornered the market, and they were just taking that data and selling it.
And the reason I was being specific, there's really big companies out there, and I don't want to cast aspersions on anybody, but one of them might look like a rocket ship, and there's others that
See, the trigger leads are done by the credit bureau, and they may not even buy, like, say your Rocket. They probably don't even buy trigger leads. They probably do their own advertising and just run it in their own Rocket funnel. It's all the small, anybody could buy trigger leads. I mean, that was just the thing about
yeah.
it is like, It's not
That's
a good way. I mean, because you got to call. They're selling it to like, on top of that, they sell it to like three people the same thing. You know, and it's like see who can go get it. You know, and it's a terrible deal for the customer.
it's that's interesting. The in real estate, in the real estate profession, that's disallowed. Meaning, once you have agency, you've established. I guess if somebody gets a letter of intent to proceed, does that lock out all the other lenders?
No, I mean, see, this is the thing about it. I mean, they're even selling. Yeah, I mean, it's personal data. I mean, that's the thing about it. It's like, the realtors are like, hey, don't step on my toes. Hell, this is people's credit score. What
Yeah.
they're doing, their phone, their email, all that stuff. So yeah, it's I don't even know how that ever got allowed to happen in the first place, but I'm glad it's and it's a bipartisan bill. It don't matter if you like Trump, hate Trump, but both parties came together and realized this is terrible for Americans and got it done. So pretty good.
And when business gets tough like it has been, I'm telling you, these phone callers, they get more and more aggressive. I mean, I
Yeah, I
I
mean,
I'll get a call from the same number two or three times. They're going to just annoy the crap out of me. 'Cause-
they've paid for it, so they're going to, they got somebody that don't care about, maybe not customer service or how to run a business, in a referral manner. Like you take care of your clients so you can continue to do business. A lot of those things are just taxi cab rides. They want you for one transaction and gone, but that's what they are. I mean, they're the taxi cab drivers
I've never
or the
heard of that.
riders.
I love that. That's an excellent thing. Um, and I'm always bragging about Rodney because, in my opinion, there is no competition. That's me. If you ever need a loan, call Rodney. His number is all pretty easy to find here. Um, but to show you, as a professional, I never even knew until I read this. I never knew about trigger leads because all the people that he does business that I promote, that he does business with me and my clients as well as his, they never talk about it because he's prepared them so well for that. It never makes it. They never call and say these lenders are calling me. I've never heard that in 15 years. So thank you for that.
We try to minimize it, like I said, with all the little tricks we did, with their trigger leads, but it didn't, I mean, we still got phone calls all the time, even though no matter what we said or did, we'd be like, why have I gotten 70 phone calls? My wife is fixing to kill me. Like, and I'm like, golly, I just hate it. Really, I think that was the last one. One of them's wife was so mad that they had gotten these calls. I was like, I get it, man. I
and,
get it.
and of course they're blaming you, or at least the process. I get it. There's the one last thing I want to cover on this, and we only just got a couple of minutes, and it shouldn't take more than that. But I want to make a point about something, and here it is. Um, it's the article is real estate veteran warns about hopelessness in the housing market and threatens the American dream. That sounds a little down and stuff, but what I'm actually wanting to address very briefly on this is the idea that the current administration is actually looking to take action on housing. We'll see if they actually do something, but to have that in the conversation, I thought was important. So so we'll just dive in just for a minute. I think for sure we're in a national housing emergency. I think we've been here for some time. This is a general, an individual with the property markets group. I don't know what's happening to my voice. But it says, and the lead up to that was, as the Trump administration considers declaring a national housing emergency, an affordable housing developer who began his career at Lehman Brothers unequivocally agrees the proclamation is overdue. As far as I'm concerned, it's right on time. If you look back over the last 10 plus years where there's been a housing emergency, no White House has really taken ownership of the issue. I thought that was important, despite the fact that, in my view, it's probably the most important issue out there in the political realm and in the realm of what's most meaningful in the lives of everyday people. I just couldn't agree more with that. On Monday, Treasury Secretary Scott Bessent told the Washington Examiner that the Trump administration may declare a national housing emergency this fall, citing rising prices and dwindling supply. The 25-year-old plus real estate veteran noted that during his career, median rents have risen 21%, while median income has increased only 2% in that same time. And 40% of the U.S. households pay more than 30% of their take-home pay on housing costs. You know, as an aside, we talked about Dave Ramsey. He says don't pay any more than 25%. And I know that Rodney has said time and again that that's very difficult these days. Would you agree with that?
Yeah, I mean just as the article explains, I mean it looks like the average is over that. So,
Yeah.
when you're talking about, um, I'd love to hear Dave Ramsey's thoughts on the unaffordability of houses, and does he still like saving up 20% before, because now if you tried to do that, you'd be saving and saving and saving. You may never get to 20% with the way these home prices are going. But yeah, I mean, I think the biggest factor is the home prices have skyrocketed. The inventory is not dwindling. The inventory is going up. I don't know how they got the inventories dwindling there, but inventory is increasing and the prices are still staying high.
Yep.
Rates are coming down, but like you mentioned there, wages is only going up 2%. I mean, wages it can't be that big of a gap, or we're going to be where we're at. And who can afford a home in America right now? I mean,
In the grand scheme of things, it's now in retrospect, it's difficult to ignore, I'll use the word the damage that the COVID era caused housing prices, because that was just an absolute rocket ship. I mean, prices just skyrocketed, and like you said, prices can go up pretty quick, but coming down takes forever. It just takes forever, and that really did some freaking damage. But anyway, I'll finish it this way, and then kind of make a point. In terms of how the White House or the administration is framing the issue, I would commend them highly on raising this issue to the top of the list of priorities. Whether you're a supporter of the president or not a supporter, I think we can all see that he's willing to try different approaches and even willing to fail. And that's kind of the mindset that's needed at the time of a crisis, which has been ongoing now for several years. You need an approach by an administration who's willing to try different things. And I won't go on, but I will say this, unless you saw something in the article you thought was super important. That's the one thing about the current, the guy didn't get to be a billionaire by accident. He's tried and failed, and he's the Dave Ramsey kind of, it's a bankruptcy, let's go again. I mean, that guy, you show me a guy that fights more than that. And now that they're paying attention to it, I mean, focus goes where attention goes, right? In that way, attention, focus flows, whatever. If we're talking about that housing being an emergency, and they've been using the emergency pretty regularly for a number of different things, it would be wonderful to have the issue of housing addressed in a serious, cogent kind of a way. I think that's the right word. How do you feel about that in general?
Yeah, I've seen where they've talked about potentially putting getting the White House focus, or October being the National Home Month, or whatever they were thinking about doing. One, I would like to see what they're going to do, like what he could actually do, because what's happened is a free market society that is a free market and an open market's what caused our house prices to go up. I mean, there's just, you're usually in a desired area and somebody's willing to pay for that. And there's an abundance of people willing to do that. Like, so what do? Do you open up federal lands and give away free lots? I mean, and part of it is part of it is, I think a different generations here now too, where they're used to having 3 or 4 bills, to where when I bought my first house, I was like, I didn't have a bill except that house note. That was only basically, and then I went out far enough from where I originally lived because it was affordable. And I don't think people are doing that. Like I want to live in Nashville because I'm from Nashville, or my parents live in that. And I'm like, you don't get to live where your parents do. Like, you get to live where you can afford to, you know. I mean, I can't see my kids buying a house around me right now, just getting out of college. I mean, it's not feasible.
Right.
So that's the thing too. I think it's generational. I think there's a lot of factors there that play into that. And I'm anxious to say, I hope he does something. I hope they turn their attention to it, but I think rates have the most effect of anything. And I
Yeah.
think that's why he's been pushing rates. He's been on Miss Jerome Powell forever about lowering rates.
He's
So
been right. He's been dogging that guy. I guess,
yeah.
you could get into taxes and gains and all that kind of stuff. There's probably a number of levers like that big money pays attention to. But I just wanted to bring that up because, and I'll leave it this way. And thank you for I so appreciate you very much, Rodney. That I think what's important for me to that article is somebody's paying attention to it, and it looks like perhaps it's going to be more than lip service. This Scott Bessent seems that what's he going to do? I don't know, but maybe just having a conversation is a great place to start instead of just ignoring it until it goes away, because it doesn't go away.
I
Great
think
show.
he's going to. I'll tell you what I think he's going to make a prediction. In Andy's, like, I was wondering too what he can do, open up more land. Yeah, I mean, they could do that, but I think what's going to happen is that they're going to remap Chicago. That he's going to go in there and he's going to send in troops to Chicago, and they're going to start over with a free housing city, because I don't think that's going to go too well. Man, just too many killings in that area. I mean, it's amazing how we've had a city like that for as long as we've had. It's just been out of control like that. But,
Oh, God, how fun. Rodney, thank you for today. Ange, thanks for being here. We are out of here. See you next Tuesday.